Hi, I'm Jenny Brown. Welcome to MFB News. I hope you're all keeping well and warm. What is going on with the weather? Yesterday I was in the office and I looked out of the window and it was actually snowing. At first I thought it was some blossom coming down from the trees, but no, it was snow. So let's hope it brightens up for the Easter holidays. Most of our kids, I think, have either broken up or break up today. So yeah, let's hope the weather is a bit kinder for us, because we all know 2 weeks indoors with children can be, well, quite trying to say the least. Now look, in terms of what we've got for you this week, it's going to be a really quick update. Firstly, because there just isn't that much news, and secondly, because I've got to zip off up to London in a minute where I'm presenting. So first of all, we're just going to cover off some updates from lenders. Then I'm just going to share with you some of the most recent information that's come around from the property market, and also some thoughts around what's going to happen with rental yields going forwards over the next 12 months or so. Okay, so another busy week in terms of repricing. It certainly keeps us on our toes as brokers. No sooner have we quoted a rate to a client than it's gone. So keeping us busy, if nothing else. So we've seen pricing increases in the last week from Virgin, Land-based. Skipton have made increases of up to 0.15% across their range. We've seen Precise Mortgages increase pricing. We've seen Paragon sadly remove a few of their limited edition products, which I love. Paragon are really interesting. Their product range is competitively priced in the space which they occupy, which is professional landlords, limited companies, HMOs and multi-units. And I probably bang on about this maybe too often, but what's really neat about Paragon is that they can lend on those larger HMOs and multi-units, so up to 20 bedrooms or up to 20 self-contained units. And some of the rates that they've had have been absolutely stunning, particularly as other lenders have started repricing upwards, and they've really held firm for as long as they can. But sadly, they had to go, so we've seen some of their rates being withdrawn. Still got some really competitive pricing, please don't worry, but actually it's just a little bit more expensive than it was. Now, we've also seen Platform Home Loans increase their rates by up to 25 basis points. We've also seen the mortgage lender increase some of their products as well. And lastly, Accord Mortgages have made some incremental changes to their pricing. So fairly clean sweep, I would say, in terms of lenders. So look, where does this leave us in terms of pricing? Because it's all very well me spouting off all these different changes, but actually, what does the market look like now? Where is pricing? So looking at personal borrowing, so standard properties in personal names, 2-year rates at 65% loan to value are now from 1.99%. At 75% loan to value, they're now from 2%. 5-year fixes at 65% loan to value are at 2.1%, and at 75% loan to value, we're looking at 2.17%. Limited company pricing is now starting from 2.98%. So look, you know, actually, I'll tell you what, I've obviously worked in the industry for quite a long time now, and I always remember saying to people, God, if you can fix for 5 years at anything under 5%, that's a really good deal. And that's kind of really where pricing sits in the normal world, i.e. when we're not in a period of base rate being, you know, very, very low and things are kind of quite settled. So actually, when we're saying that you can fix for 5 years at 2.1%, actually comparatively things are still not bad at all. They're just more expensive than they have been historically. Now, interestingly, how are lenders combating these changes in pricing? So what they're actually doing is reviewing their broader criteria, and we're seeing some changes trickling through, which we're obviously reporting on every week. So yeah, some changes to report on there for you coming up. So Skipton are a lender who have made some fairly large actually changes to criteria. In terms of the changes they've made are significant. So one of the things that they have done is introduce the ability to lend on new build flats at up to 75% loan to value. Previously, they just weren't lending on new build flats whatsoever, and their categorisation of a new build flat, it is anything which has been built or converted in the last 2 years. Now that's quite an interesting one. So there are a lot of lenders who are very, very comfortable treating new build flats like they do every other kind of property. So there's no differentiation, but there are still some lenders who shy away from high loan to value lending, or indeed lending at all on new build flats. And the reason for that is really just a concern about the actual longer term value of these units. As we know, when we buy flats or properties that are brand new, a bit like buying a new car, the value tends to be a little bit kind of over inflated because of the new build value that's associated with that property. The concern is that actually once the property's been occupied, it stops being quite so new and shiny. The value would essentially come down to be more in line with other non-new build properties in the area. So some lenders exercise some real caution there. This is a fallout, actually, interestingly, from the credit crisis, where there's, for those of you who've been in the game long enough to remember this, just before the credit crisis, there was a huge amount of new build going on, particularly in the sort of northwest of the country. And so these particular properties had some real issues when the credit crisis happened, and there was an oversupply of stock, and also the values dipped after the kind of new build element had worn off because of the reasons I've just explained. So lenders kind of got stung with this a little bit. So some of them have kind of come back to market now and are actually sort of business as usual, but other lenders have really held on to this. So it's very, very interesting to see that Skipton have not just come back in at a conservative loan to value from no lending on new builds at all, but they've come back in at 75%. Now, the other thing that they've done, which I found really encouraging, is they have reduced their rental calculation on their 5-year fixed rates. So what they were doing is stressing at 145% coverage, assuming an interest rate of 5%. But what they've done is reduce it so that it's now 145% coverage, assuming an interest rate of 4.5%. Now, that means that essentially you can borrow more per pound of rental income than you could do before the changes. Now, in terms of what they've done, is this kind of revolutionary and setting them apart from with their peers? Absolutely not. Is it bringing them in line with other lenders? Yes, it is. But it really leads on to a question around the rental calculations and how things are shaking out at the moment. So this is one of those areas that lenders have some flexibility in terms of the rental calculations they use. Skipton have been using something more onerous. They've given themselves some wiggle room here. So actually, in a time where things are really slowing down for them, they've been able to kind of make a change to try and drive up new business. We have seen other lenders make calculations or changes to their calculations which are quite similar in the recent weeks, and I expect more will follow suit. Now, the calculations that we're seeing, so when we're looking at remortgages, particularly remortgages for individuals, so not limited companies, we are finding that for properties which are lower yielding, so generally speaking in the south of the country, and for people who are looking to borrow higher loan to value, so really anything, I would say at 70% and above, the rental calculations are quite challenging for individual borrowers. Having said that, there are a couple of lenders who have made some tweaks to their calculations where the numbers are fitting quite nicely. So being more generous. So 145 at 4.5% is not bad. This is what Skipton have just changed to. But actually there are more generous calculations than this. So if you have got a buy-to-let in personal names, you're looking to remortgage and you're finding the rental calculation isn't quite working out, do give us a call actually, because there are some very interesting offerings available from lenders in the market which can kind of come in and scoop up those deals which aren't fitting with the kind of typical high street lenders. Now, Peppa have done something in the last week which I'm actually quite excited about. So what they're doing is that what they say they're on is on a mission to help their customers go green, which I quite like, obviously. Now, what they're saying is they've launched a new initiative to help their customers understand how to make their homes more energy efficient. So what they're doing is for all their existing customers, they're offering a free energy efficiency survey and energy performance certificate with a tailored action plan. So essentially what's going to happen is someone's going to come to the property, look around, assess how energy efficient the property is, come up with a bunch of recommendations in terms of what you can do to drive up the energy efficiency of the property. And what's really neat is that in addition to this, if you then take some of the actions and make good on them, they will then send this person back out to resurvey the property and get a new energy performance certificate, so you might get a better grading. Now, the reason that I really like this is obviously, first of all, landlords, well, I mean, I'm in the same position myself at the moment. So I've got 2 properties, neither of which are an EPC rating of C or above. And I'm scratching my head thinking, God, there's obviously things that I can do to this property, but I don't really know what I can do to it, what it's going to cost me, and actually which is going to have the bigger kind of impact on the energy efficiency of my property. So having somebody come out, inspect my property and say, well, actually, if you do this, this and this will really help things, would be really, really good. So I'm really, really impressed that Peppa are kind of proactively offering this opportunity to existing borrowers of theirs. So I think really this is quite pioneering. I really do hope other lenders follow suit. If any lenders are watching this, just know this is going on. It's a great idea. I think all landlords would welcome this. So great to hear that Peppa are doing this. And if we hear of any more lenders offering the same thing, we'll obviously let you know, because it could be that you could be eligible for some free support, which obviously we'd all really appreciate. Okay, just a very quick nod to house prices because I'm sure you're all very sick of me going on about them every single week. The Nationwide have just released their latest house price report. What they're saying is that house prices jumped at the fastest annual pace since 2004 in March, as the nation's property market continues to defy the wider cost of living crisis. The prices jumped 14.3% from a year earlier, taking the average value to a record £265,312. In March alone, prices rose 1.1%, and both of these figures were above economists' forecasts. UK home prices have risen for 8 consecutive months and now stand at 21% higher than they were before the pandemic struck. While some forecasters expected gains to slow in 2022, as higher inflation and interest rates squeeze budgets, the surge is currently showing no signs of letting up. Now, what's going on here? So essentially, what we are seeing is that the amount of properties which are for sale is way lower than it normally is. And while there's certainly an increase in stock now starting to happen, the numbers available of new properties to buy available is just simply too low. So actually, is it that there are loads of people looking to move house, or is it that there just isn't enough supply to keep up with the demand? I suspect that actually if there were a lot more properties for sale on the market, we wouldn't be seeing the same level of house price growth. But because there are so few properties available for sale on the market at the moment, which is not keeping up with demand, that's really kind of pushing things up. It's putting a lot of pressure on prices there. So I think actually in terms of what's going to happen going forwards, look, there is still very much a confidence in the housing market. Despite everything that's going on in terms of inflation, cost of living, the war, people are still thinking house prices are going to increase. Are they going to increase at the same level as they have in the last 12 months? Absolutely not. But an expectation is what we're not going to see, which I know some landlords are really kind of sitting and waiting for, but before they go and invest again, is a crash. That is absolutely not being predicted by the economists. Now lastly, just some interesting content that I came across. So there's a chap called Paul Broadhead, who's the head of mortgage and housing policy at the Building Societies Association. And he's been providing some commentary in terms of his thoughts on the buy-to-let market in 2022. So what he's saying is that, first of all, Zoopla have recently reported that the number of people searching for a rental property was 76% higher in the new year than during the same time between 2018 and 2021. And what he believes is that this may be driven by younger people leaving their parents' homes post-pandemic and striking back out into the UK cities. There's also a thought this is further exacerbated by the sheer number of people who are renters who, when the pandemic struck, simply moved back with family. They're now looking to come back to city centres or move back out on their own again. But the key point here being that the number of people looking for rental properties is much higher than it has been in previous years. Now, what he goes on to say is that right now, supply, demand and rental yields are in the landlord's favour. But he does believe that other economic factors can dampen activity as the year progresses. So what he's essentially saying here is that right now, actually, things are really good for landlords. We've got increasing rents, increasing property values. And actually, there's a sort of shortage of supply of buy-to-let properties, a large amount of demand, and that's really kind of underpinning everything. However, as the year progresses with inflation and everything else that's going on, that could really start to dampen all of these things. But right now, things are holding really firm. Now, what he goes on to say is that amid the financial difficulties many are facing brought about the pandemic, rising numbers of adults are looking to the rental market as a way to boost their income over this period. Interestingly, around 17% of the adult population in the UK, which is equivalent to 10 million people, have considered becoming a holiday-let landlord. And this is based on research from the Suffolk Building Society. So what does this tell us? Now, this is an interesting one. I was having a chat with my dad the other day about this, and I was saying, I wonder how landlords are feeling about investing right now. There's a lot of nervousness about the economy, about inflation, interest rates are going up. Is actually now a good time to invest in property? And he said, the thing is, Jenny, what you have to remember is that actually, as a retired person, a person with money who in savings, actually my income is not keeping up with inflation. If I put my money into a really good interest-bearing savings account, at the moment I can probably attract a rate of about 1.7%. Whereas actually if I were to buy a buy-to-let property, it would outstrip that. Would it keep up with inflation? Possibly not. But actually it would give me a far better return on my investment than putting money into building societies would. So actually that's quite an interesting point, isn't it? That even if people are kind of nervous around the housing market, nervous about the economy, it could be that actually it's a sheer kind of necessity to keep keep up with inflation, to make sure your income kind of keeps aligned, actually using a buy-to-let, investing in property could be a really, really good thing. And that's probably why so many people, 17% indeed, have been considering looking at investments in property. Interestingly, holiday lets being the key one there. And that's us done for this week. Thank you as always for joining us. Like I said, I'm dashing off up to the National Landlord Investment Show at the Excel. I'm there, or we there at Mortgages for Business are there today and tomorrow. I'm presenting both days. So if you are at the show, please come and say hello to us. We would love to see you. In the meantime, questions always welcome, 0345 345 6788, or please feel free to have a look at our website, Mortgages for Business. I will catch you guys again this time next week. Look after yourselves and keep warm. Have a great weekend.